If you have a pension in Ireland, I have one question for you. What is your investment strategy? To simplify it, how much of your money is in equities or shares, and how much is in fixed income or bonds? For 40 years, the standard answer was 60-40. 60% in shares for growth and 40% in bonds for safety. Here's why this matters more than a portfolio debate. The 4% rule, safe withdrawals, almost every retirement plan ever written. They're all built on the assumption that a balanced mix like a 60-40 portfolio holds together. Pull that foundation out and the rules a whole generation is retiring on begins to wobble. And right now, half the financial industry is telling you that that foundation has actually gone. The other half is telling you that it's never been in better shape. So, in this video, I'm going to show you 3 things. I'm going to assess both sides of the argument, then give you my honest verdict, and number 3, the one thing to change the 40% that is actually worth your attention. So on the surface, this looks like a genuinely hard question, and here's why. In 2020, the 60-40 portfolio had one of its worst years in history. It fell by around 17.5% in that year alone. And the reason it hurts so much is that it broke its own promise. The whole point of the 40% in the bonds is to hold up when the shares fall. However, in 2022, shares and bonds fell exactly together. So there was nowhere to hide. This is what set off every obituary you have read since. But then something inconvenient happened for the doomsayers. The 60-40 recovered. In 2025, a standard 60-40 mix returned about 15%. So you have a strategy that looked dead at one point, thriving a couple of years later. And that is a trap. You can argue both sides using real numbers. Now, for an Irish investor, this is not simply an academic debate. When you retire and move the balance of your pension into an ARF, you are personally responsible for the split between growth and safety. If you've crystallized a pension, imputed distribution will kick in. From age 61, you must take at least 4% of that fund every single year, whether you want to or not. Then from 71, it rises to 5%, and our funds above €2 million at 6%. So you are selling down a slice of your pension every single year. If you're selling into a portfolio that is badly built, that does lasting damage, which means getting the split right is not a theory for you. It is critical, as it's your income that will last or needs to last for 30-40 years. So let us go through it properly and assess both sides of this argument. To judge whether 60-40 is dead, you have to understand why it worked for so long in the first place. The idea rests on one assumption. Shares and bonds move in opposite directions. When the economy is strong, equity markets rise and your growth engine job does its job. When the economy stumbles and shares fall, money flows into bonds and they subsequently rise. Gives you basic diversification. But from the early 90s, late 80s, early 90s, right through to 2021, interest rates have effectively been falling. And when interest rates fall, the price of existing bonds, they rise. So for 4 decades, your safe 40% was not protecting you. It was actually quietly delivering strong returns at the same time. That is the era the 60-40 was born, and essentially it flattered the strategy enormously. But in 2022, central banks changed that pattern. Rates began to rise sharply, and what happened? Bond prices fell. Now hold that thought. Every argument that follows is going to trace back to that. First, the serious case on why the 60-40 is finished. It does not rest on one bad year. It rests on the claim that the world has changed. I'll start with what actually broke in 2022. Shares and bonds fell together, which the model says would often never happen. And the people calling it dead make an uncomfortable point about that. For most of financial history, shares and bonds did move actually together. But the 40 years where they reliably moved apart may have been the exception, not actually the rule. If that is true, the safety you think, the feature from day one, well, that era is over. BlackRock put hard numbers on this. And they're not comfortable reading. Their research found that in recent years, on the days shares fell most, bonds usually fell too. The hedge failed precisely in the moment you actually needed it most. And their argument is that this is a structural, it is not simply a blip like we saw in 2022. Higher inflation is the enemy of both at the same time. Then comes the heaviest voice in the room. Larry Fink, he runs BlackRock, the largest money manager on the planet. In his 2025 letter to investors, he questioned the 60-40 60-40 portfolio. He suggested the new standard should actually be 50-30-20. 50% in shares, 30% in bonds, and 20% in private assets. What's that? Things like property, infrastructure, private credit. When the biggest firm in the world redraws the default, people need to pay attention. It's not to say that bonds may no longer protect you in the way they did in the past for the past 40 years. That is a real argument backed by real data, and I do not dismiss it. But you've not heard the other side yet, and the other side is potentially just as strong. The case of the 60-40 is fine, it's less fashionable, but it's equally as strong. Start with what happened straight after the crash. It fell hard in 2022, but then it recovered quickly. For about 10 years, bonds barely paid anything. Yields were close to zero. You owned them purely for safety, and you accepted almost no income for it. That has completely changed. Bonds now pay a real rate of return again. The rise in interest rates that hurt in 2022 is almost what makes bonds attractive now. So for the first time in 15 years, the 40% is doing two jobs again. It steadies the portfolio, it actually pays you something to hold it. But then there's a deeper point about what really went wrong in 2022. That was a year with inflation shock, and inflation is one of the things that hurts shares and bonds at the same time. When inflation spikes, interest rates typically jump, and both sides of the portfolio, they will fall together. But that is not how most downturns work. In a normal recession, where the worry is slowing growth rather than runaway prices, bonds will still hold up and do their job. Look at 2008 or the early crash of 2020. Shares fell hard, bonds rose and cushioned that blow, exactly as they were supposed to do. So bonds did not necessarily stop working. They failed in one specific scenario, an inflation shock, and held up in the other scenarios. Once interest rates reset higher, the big fall was done. Bonds cannot keep falling from zero yields because we have left zero behind. Your shares were always the main driver of your risk, always. The bonds were never the engine. They were a small brake on the side. Bonds were never doing as much of the heavy lifting as people imagined or should have anticipated, which means running away from bonds is solving a problem that was never really there in the first place. And when people do run, they have to put that money somewhere. This is where it gets more dangerous, and it sets up one of the most important parts of this video, because the things people run into are often riskier than the bonds that they left in the first place. So you've heard both sides of the argument. Now, let me break down and tell you what I really think. Is the 60-40 dead? No, but the lazy version of it is. The mistake was ever treating it as a number you set once and never look at it again. But built carelessly, it will let you down. Built deliberately, it will still be one of the soundest foundations that an investor can have. So, I do not think the job is to bury 60-40. The job is to build it properly. And that brings me back to Mr. Fink and the 50-30-20 idea. It is worth understanding why the largest manager in the world is pushing private assets. Part of it is a genuine view that diversification needs to be wider than shares and bonds. And part of it, frankly, is that selling private assets is very good for his business. That does not make him wrong, but it means you weigh the argument, not the brand behind it. And when I weigh it, I land here. The case for adding something into the 40% is real. The case for tearing the whole thing up is not. But before we go further, we need to be careful about a word. What does private assets actually mean? It is a very broad bucket. It lumps together property, infrastructure, private equity, private credit. And those things are not interchangeable, they are completely different. That distinction, more than almost anything else in this debate, is important to clarify. Private equity is buying companies. It is a form of ownership that is a share-like risk, so therefore it belongs in the 60%, not the 40%. If you swap safe bonds for private equity, you have not diversified, you've just added more of the same risk that you already held in your shares. The only one of these that genuinely competes with your bonds is private credit, because private credit is a form of lending. It is not owning. So the pitch is simple here, and it is potentially seductive. Swap some of your low-paying government bonds or high-grade bonds for higher-paying private loans. You pick up extra income and a return that does not bounce around with the stock market every single day. For the right person and in the right amount, I think that could potentially be a reasonable idea. I used it selectively in my pension, but it's not a like-for-like replacement for safe bonds. And treating it like one is where people will often get hurt. So here are the 3 things that you have to respect before you go near it. The first is liquidity, and this is the big one. A government or high-grade bond can be sold any trading day of the calendar year. Private credit can tie your money up for years. Many of these funds only let you ask for your money back once a quarter, and they can cap how much you can actually leave the fund, often at around 5% of the fund per quarter. In calm markets, that limit never really bites, but in panic, it absolutely could. We've just watched this happen in real time. In early 2026, we saw that investors tried to pull 9 to 10% out of some of these funds in a single quarter, and many of them were bit. The funds only allowed 5%, and some people were locked in holding an asset that they were unable to access. So that is part of the risk. Even BlackRock had to enforce the gate on some of its own private credit funds. Now, in fairness, that gate is a structure working as designed. It ensures that you don't have a fire sale that would essentially hurt everybody if they allowed mass floods out of the fund. But you need to know, going in, that the door can be held shut exactly when you may want to leave it later on. The second thing is to respect that it is real lending risk. It is not government-grade bonds. These are loans to ordinary companies. In a deep recession, some of them do not get repaid. This is a completely different risk to lending to, say, the Irish or German state. So it does not belong in the same bucket as your safe bonds. And there is a quieter point that sophisticated investors are now noticing. The extra yield private credit pays over public bonds has been shrinking. In some cases, the two now pay roughly the same, which means you're accepting lockup for less reward than before. Now, the third thing, this is specific to Ireland. It has genuinely changed the picture. Until recently, private credit here was effectively for large institutions only. Now, new fund structures are beginning to emerge, and they are called ETIFs. They have started to open up to ordinary investors, and nearly every one of these new Irish funds is a private debt or private credit strategy. Inside an IRF, revenue forces you to draw down at least 4% of your pension pot every year. But it is exactly the kind of thing that has to be planned around. The death of the 60-40 essentially is overblown. The need to build it deliberately is very, very real. For the right investor, a small, measured slice of something like private credit can earn its place. And I say small again. Replacing a portion of the bonds with your eyes fully open to the lockup and the lending risks. A sensible slice is very small. The single digits of the overall portfolio, not a wholesale switch. But, and this is the whole point, this is the decision you make on purpose inside a plan, not a trend you chase because the biggest firm in the world wrote a letter to its investors, or you saw it in some other YouTube video. You need to have a plan, and you need to stick with the plan. So let's bring this all home to your pension here in Ireland. If you're anywhere near retirement, this is not theory. It is your income for the next 30 or 40 years. So you need to be thinking about it. And our system hands you this decision whether you want it or not. When you move into an IRF, you choose the mix of growth and safety. Not a pension trustee, not your old employer, not essentially even your advisor. This is where I see the same mistake being made again and again. People drift into very cautious setup without ever actively choosing it. And it gets carried straight over from a pension that was automatically de-risking in the years before retirement. It can feel responsible, and it probably was responsible. The label says cautious, and it could be quietly be the riskiest choice of all. Because at 65, you might have 30, 35, 40 years retirement ahead of you. A portfolio that is too defensive may simply not grow enough to fund those decades of income in your retirement. If your fund is growing at 2 or 3% and you're drawing 4%, remember that pot is going to shrink every single year. So your fund has to be built to grow through the drawdown, not just sit still and be drained. And here's the second danger most people they're not talking about, and it's called the sequence of returns risk. It is simply this: the order of your returns matters enormously once you begin to draw down income from the pot. A bad crash in the first few years of your retirement while you're selling units to live on can do permanent damage. It pulls your pension pot forward. The same average return in a different order can be the difference between a comfortable retirement and you running out of money. So let me give you the real conclusion of this entire video now. 60-40, 50, 30-20, the exact ratio is the wrong thing to obsess over. What you need to focus on instead is only has meaning once it sits on top of a proper financial plan. A plan that knows your income needs, a plan that knows your tax position here in Ireland, and exactly when you will draw each part of the pot. Get the plan right and get the correct allocation follows and will be much, much easier to define. Get the plan wrong and no clever allocation in the world will save it. Your portfolio is the last decision you make, not the first. So get a plan on paper. This is what I do. And this is why I do not start with a product or a fund. So if you're looking at your own pension now, wondering whether the safe part is actually safe at all, or maybe it's too conservative, this is exactly the conversation is worth having now before you've locked anything in. If you would like a free conversation, the link is in the description below. No pitch, no pressure. We'll look at what you actually own and whether it is built for the next decade or if it was built for the last one. And whatever you decide it on purpose. That more than any ratio is what will protect your retirement.